Ladies and gentlemen, welcome back on my YouTube channel for another supply and demand trading strategy lesson. You ask for it and I deliver. It's another freestyle lesson where I go through the slides, explain the theory, and right after we're gonna do a practical hands-on application on the charts where I again explain the theory but right on the chart. Now, without further ado, let's get into the nitty-gritty of supply and demand. And by the way, again, I want to stress quickly that so far, we only covered a very small portion of supply and demand. Whether it's 10%, 7%, 12%, it doesn't matter. But we covered only a very, very, very small portion of supply and demand. And today, if you like the previous lessons actually, then now you really gonna enjoy what we are starting now, because now we slowly start answering the question, which is the right zone to take to trade? And obviously, you cannot easily answer that question, and there's a process behind. And I call that process three-step mechanical process. And today we cover step one of that three-step mechanical process, which is basically location. Now, we have a big agenda for today's lesson. I'm gonna give you an overview of the three-step process. I'm gonna look at the income streams and give you a definition of the income streams. In other words, multiple time frame analysis, because it's really important that real supply and demand, what we cover here on my YouTube channel, that's real, the original supply and demand. If you have watched other supply and demand videos from other traders, I can guarantee you, if this doesn't come close to what we are doing here, it's not real supply and demand. This is the real supply and demand. That's the real deal. And so you're going to see basically that you can apply the strategy in all kinds of income streams, meaning you can apply it for daily income, which is day trading, and you can apply it also for weekly income, which is swing trading. Now, then after that, I'm gonna start covering or give you an overview of location, and then which is step one of that three-step mechanical process. Then we're going to cover the steps to identify location. I'll give you the location rules on a HTF, that stands for higher time frame. And then right after, whatever we learned in terms of theory here, I'm gonna show you on the charts and do a practical application session. All right, now that's the overview of the three-step process. Now the first step, and this is what we start covering today, it's called location. And why it is called location? Because location is used to assess current location on the chart in higher time frame HTF. So we use different time frames to evaluate whether a zone is located in an ideal context for us to take advantage of it. In other words, we use location to determine whether price is cheap or whether price is expensive, or whether price is in what we call equilibrium. And equilibrium means it's like in the middle. It's basically for us something that is not then interesting to trade at all. And you always hear the saying, hey, we buy cheap and we sell expensive, or we sell expensive and buy cheap. And that's exactly what we identify, we can quantify actually with that location step. So we can then really determine, hey, on XYZ market, price is cheap, so we are looking to buy, or price is expensive, so we are looking to sell, or in other words, short. The second step of the three-step process is direction. And direction is used to assess current direction. In other words, you could call it just simple trend on the chart, also in HTF higher time frame. And the last step of the three-step mechanical process is called zoning process. And this is used to place your set, stop, entry, target. And this is done in LTF in lower time frame. All right? And from now on to the rest of your trading career, that's gonna be your 3-step mechanical process when you trade supply and demand. Now, let's look at the income streams. So yes, you might be familiar to terms like swing trading, day trading, scalping. We're not going to cover scalping, by the way, here. And so we changed that terminology now a little bit, just that we are all on the same page. So we have daily income, which is basically, you could consider it as, or compare it to day trading. So this is basically for trades that last for a few days or hours. Then you have weekly income. So I'm a big fan, obviously. As you know me, I'm a swing trader. So weekly income and also kind of monthly income in a way is for me swing trading. So trades that last for a few weeks or days, or trades that last for a few months or weeks. I already in the past, I would say in the past year, I had a trade even that lasts for like close to 2 months. So yeah, so that's for me monthly income, weekly income, obviously more like weekly income is swing trading, and then daily income is more like day trading. So that supply and demand strategy that we teach here can be applied on all the different income streams. Now, what are the time frames to use? And this is an important question that we cover here now in this lesson. What are the time frames you use for these 3 different income streams? So for daily income, well, where a trade lasts hours or days, for your higher time frame, basically for your location and direction, use the daily time frame. And for then the zoning process, you would use basically these different time frames, which is from 2-hour to 4-hour to 8-hour charts. So you can play around with these charts for lower time frame. So basically for daily income, for day trading, you would find your location and your trend on the higher time frame, which is your daily chart. And then you would go to the lower time frame to define your set, your stop entry target on these different time frame, which is from a 2-hour chart to an 8-hour chart. And then you have weekly and monthly income, where trades last from days to months, or maybe from weeks to months. And here we use for the higher time frame the weekly and the monthly chart. So when we look at location, our higher time frame, location and direction, whether price is cheap or whether price is expensive or whether price is in equilibrium, we're gonna use a weekly and a monthly chart. And then when we look at trend, whether we're an uptrend, sideways, downtrend, we're also gonna look at these same higher time frames. And for the lower time frames to place our set, we go then down, basically starting from a 600-minute to a daily time frame. So what I personally like to do usually, I like to basically cover my location on a weekly and monthly chart, and then I go down to the lower time frame. Usually it's daily chart or 960-minute chart that I also like quite a lot to define my set. And what you have to understand in terms of supply and demand concept, and that's actually really, really important. The bigger the time frame, the bigger the imbalance, the more unfilled orders, the higher the probability of a successful trade. And that's why I'm such a big fan of weekly/monthly income, because I see the big picture of any market. And I have a higher probability of a successful trade. And the lower you go, and that's why I didn't even cover high frequency trading or scalping, however you want to call it, because obviously here it would be the lowest time frame, the lowest imbalance, the lowest amount of unfilled orders, the lowest probability of a successful trade. So that's why obviously I spent most of my time here in this area. Weekly and monthly income, which is basically swing trading. Now, let's go into step 1, location, and give you an overview. So step 1 of identify location is basically first you identify the first fresh supply zone. Now you see already a new terminology here, fresh. What does freshness mean? I'll cover that in a second, and for that I'll go into the slides. And then for step 2 is basically identify first fresh demand zone on the higher time frame. So these are your first 2 steps. So you first identify supply, and the second step, you identify demand. And the zones, they have to be fresh. Freshness is one of our zone qualifiers. Zone qualifiers, zone qualifiers means it quantifies the quality of the zone, whether it's going to be a good quality zone or a bad quality zone. And I'll go through these zone qualifiers in another lesson, and this is going to be a couple of lessons. But I briefly want to explain what freshness means, and therefore I really need to go to the slides here quickly. Now, it doesn't really matter what market we are looking at and what time frame here, because this is where we also then later on cover the on the Swiss franc futures. We're going to cover the location. I'll show you how to identify the location properly. But let me go quickly to a daily chart here to explain freshness. So freshness can be measured in multiple ways, based on the preferred version or based on the wider version. So let me make you one example here. Let's assume you have this rally-based drop. Now, freshness means basically, has the zone been touched or violated before? And you see, if you go to the right here, you see price has never been violated before. It's fresh. I mean, based on the wider version, if I really be very precise, there's a let me do snap mode here. You see here. So you see, now this has never been touched. The closest that price came to that zone is here. And also if I look at the preferred version, which is basically almost here similar than the wider version, it has never been touched here as well. Now, I just give you that as an example. Let's assume price here, this had a very long wick inside that zone. Well, then it would be a violation of that zone, and it would be not fresh anymore. Or if price just came very close to that, but never touched that zone, very close, like this, it's not a violation because it has never touched this zone, so it's still fresh. And freshness can be measured based on the wider version and based on the preferred version. Where you see here, based on that zone down here, that drop, base, rally, where you see price dropped and came back, and you see it tested that zone, that drop-based drop, it tested that zone twice. So it's not fresh anymore based on the wider version. But if I draw the preferred version, which would be here, I can say it's still fresh based on the preferred version. If there was a wick like that, then it would be not fresh based on the wider version, and it's not fresh based on the preferred version. It's very important to make this, to distinguish these two things. Now, this was just in a nutshell about freshness. We cover freshness and something like authenticity of a zone later on when we cover zone qualifiers. And zone qualifiers is important for step 3, the lower time frame zoning process. Now let's go back to the slides here. All right, so now you understand that we have to identify, when we look at step 1 and step 2 of location, only of location, right? So that we have to identify a fresh supply zone and a fresh demand zone. And what kind of freshness? Now we have seen already, hey, should it be fresh based on preferred version? Should it be fresh based on wider version? The rule here, and by the way, I don't like the saying, rules are made to be broken. That's nonsense, especially in trading. But rules are made to be adjusted. What do I mean by that? Some rules are fixed. They can never be adjusted. Like step 1 and step 2, that's like fixed rules, all right? There's nothing you can adjust here. However, if I say here, freshness test based on preferred, and a violation of approximately 25% is still be allowed. That would be a rule that I give you. It's a basic rule. Why do I say now, hey, it doesn't have to be fresh based on it doesn't necessarily have to be fresh based on a preferred version, because a violation of 25% is allowed. Because conceptually speaking, a higher time frame zone, like a high quality weekly or high quality monthly zone, usually is been tested a couple of times. Not only once, not only 2 times, sometimes even 3 or 4 times, if it's a high quality weekly or monthly zone. So that's why I say, okay, a small test, quote unquote, a small test, and then we have to quantify what does a small test mean. Here I say approximately 25%, all right? It's approximately. So, and I'll show you then later on again how we would do that on the chart. So we have to measure freshness here for location. And how do we measure freshness? Based on preferred version. All right, wider version, it can be violated, we don't care, but we measure freshness based on preferred version, and a violation of 25% is still allowed, because conceptually speaking, a higher time frame zone, usually on a weekly and monthly time frame, if it's high quality, it's been tested a few times before it breaks. Now, how do we draw the zones? Proximal based on preferred version. Leg out has to be decisive or explosive. Of course, we have again some proper rules for every single step here. And there's an alternative rule that we might not cover today, because sometimes it's really hard to identify demand or supply on that higher time frame, because nothing really fits these rules. And then we would basically, that's why it's called only alternative, if you don't find a proper supply and demand zone that meets your high quality standards, your high quality rules, then we would basically say everything that looks like a level is a level. All right. And then step 3 is basically position size, where we, not position size in terms of place and order, we would divide a range defined by distal lines of supply and demands into 3 equal sections. What does it mean? I'll show you in a second. This is basically then, if you divide a range defined by 3 distal lines of supply and demand into 3 equal sections, it's basically, you then you see directly whether you are cheap on the location, whether you are expensive on the location, or whether you are basically in equilibrium. Now the first step, right? The first step of location is, all right, I get into my higher time frame. Let's say it's the weekly chart because we're going to do weekly income, monthly income, swing trading. Then you identify supply. All right, first supply, you could identify first demand, it doesn't matter, but you identify first supply on the higher time frame. And remember, it has to be fresh based on here the freshness rules. You measure, you test it based on the preferred version, and the 25% violation plus minus is still okay. Step 2, now you identify demand. And again, same rules apply here as compared to identifying supply. You use the freshness rules that we just talked about. Now you split, and this is where you see it now here. Now I hope it's a little bit clearer than just verbally explaining it. You divide the range from distal to distal. Let me get into a laser pointer. From distal to the lowest distal to the highest distal. No worries, we'll go into a chart as well. And then you split it into 3 equal parts. And then you see exactly, you get 5 different areas. You get high and very high, or in other words, expensive and very expensive, which is the whole area up here. And this is for you the area. If price comes up here, this is for you the area where you look to short. It doesn't mean you're gonna short. This is very, very important. You have to make this. You have to determine that clearly. That okay, if price is in this area, expensive and very expensive, or high or very high, however you want to call it, this is where you can look to short. But it doesn't necessarily mean you're gonna short. If price comes all the way down here to cheap and very cheap, or low and very low, this is where you are allowed, based on your rules, to buy. But it doesn't mean you're gonna buy just by default. It just means you're looking to buy. And if price is in equilibrium, also perfect, because it means this is the no-touch area. You're not gonna look to buy, you're not gonna look to short, you're just waiting out. So, from right to left, again, step 1, you find the nearest supply zone that has to be fresh based on our freshness rules. Then you go to step 2, which is you identify your first fresh demand zone based on your freshness rules. Again, all of that on a higher time frame. And the last step, you divide the range from distal, the highest distal, to lowest distal into 3 equal parts. So you get basically 5 parts: very high, high, equilibrium, low, very low, or in other words, very cheap, cheap, equilibrium, expensive, or very expensive. And these are your, rules for everything, for basically for drawing the zone on a higher time frame. Your leg in has to be made of decisive or explosive candle. It can be a rally or a drop, obviously. Your base, you draw based on the preferred version, and it has to be fresh based on the 25% preferred rule, what we just covered in theory for the past 20 plus minutes. And the leg out is made of a decisive or explosive candle. If these rules are not being met, then you could use the alternative rule, because you are not going to trade this zone. You have to understand that, right? For trading, we would go to a lower time frame later on. It's just basically to identify, hey, I'm expensive in location, I'm cheap in location, or I'm in equilibrium. And if there's no zone visible according to our rules on higher time frame, and these are very, I would call them conservative rules, then you can apply the rule, everything that looks like a level is a level. Because sometimes you can clearly see, hey, there's a rally-based drop or drop-based rally, there's a clear U-shape or inverted U-shape. You can clearly see it, but one of these very conservative rules are not being met. Well, you can still allow yourself, if you use the alternative rule, to draw this zone. All right, that's the theory. It's a lot of theory. And now we will do this on the chart. Now we do this on the Swiss franc futures, and we do weekly income, and I'll start with a higher time frame weekly chart to identify a location. I start with current price. And first step, remember, when it comes to location, identify supply. So we go up and left, and you see we had a supply zone here, a drop-based drop. We had a supply zone here, but that supply zone has been violated already. It's right now going out from that supply zone, but has been violated, you see, way more than 25%. It's almost like 80% or close to 90%. So it's a violation. Now we remove that, so we go higher, and we see here a drop, a base, a drop. So that zone, based on wider version, you see, based on wider version, and look at that, how interesting this looks like. Based on the wider version, it has been touched, just a shallow touch, and then price dropped. But based on the preferred version, it's fresh. And you see now, I want to make this example. If price came already into that zone, just like that, we could still define it as fresh, because it wouldn't have violated the 25% violation rule. Because it's not been tested by 25% of the zone, maybe by 10%. Again, we eyeball that, all right? Now, if price would have been inside that zone like this here, we would say, hey, it's been tested by roughly 50%. So it's been tested by roughly 50%. Then we would need to go higher, because then it would be a violation of the zone. But since that zone is fresh, based on the preferred version, perfect, we can now go to the second step of location. We can find demand. Now, you see here, and this is where we can talk about a little bit about everything that looks like a level. It's a level rule, where you see here a drop-based drop, but then you could argue, if you follow the rules, hey, Bernd, look at this candle here. This is clearly indecisive candle. So it's a clear indecisive candle. So I would need to incorporate this as well. But when it comes to real trading application versus strictly following the rules, I would say this is the zone that we would highlight here as our demand location. However, and I also want to show you the difference here. You could say, okay, this is violated. You see here, you would say, okay, this is roughly 25%, maybe violation. Here, maybe not, maybe yes. But if you say it's been tested for you already, then you could just go lower. And you will see that basically from a location point of view, it doesn't really matter. And I'm going to showcase that to you as well. So if you say, and it wouldn't be wrong, by the way, if you say, look, rally, base, rally, I'm drawing the preferred version as we just did. It's been tested. 25%, a little bit more, so I'll go lower. For me, it's not fresh anymore. If you say that, it's not wrong. So you go lower, and then you see that drop, base, 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 big rally, and you would highlight this one here. Now, whether we're gonna now use this one or this one as our demand area, it doesn't really matter, and you see why in a second. Now, if I use this one as my demand area, now my last step in identifying location, which is basically I have to split this area from distal, this is the lowest distal, to highest distal, into 3 equal parts, and then I get 5 parts, which is basically here to here, right, distal to distal. With my TradeStation, I basically just do 33% and 33% and 66%, and then it draws me these lines just by default. Most probably TradingView is exactly the same. And then I remove this for now. Then I get like these different areas. Now I have this area, I have this area, and I have area 1, 2, 3, 4, 5, or however you want to count, 1, 2, 3, 4, 5. Now, I'm just doing this very slowly and visually, so for you to fully understand that. And so this is basically very cheap down here. In demand, this is very cheap. Spelling, we should spell it correctly, right? Now, this is cheap. Now here, I hope I spell it correctly. This is equilibrium. Maybe double L, I don't know, from top of my head. Very sorry. And this is expensive. And this is very expensive. All right. Now, we clearly now are able to quantify our potential, and the word potential is very important, our potential action. We don't determine our action because this is based on multiple more variables, but we quantified our potential action. Because right now, where's price? Price is in equilibrium, meaning no touch area. We're not going to look to buy the Swiss franc. We're not going to look to sell the Swiss franc futures here based on weekly income swing trading location rule. Now, if price comes up here, then we are allowed to look to sell short the Swiss franc futures. By the way, Swiss franc futures, I hope you watched my challenge documentary, my live challenge documentary on YouTube. We traded the Swiss franc futures, or in other words, we traded the USD Swiss franc. So it was the inverse pair in Forex. And if price comes down here to cheap, and this is where you're allowed to look to buy the Swiss franc futures, and allowed to, but it doesn't necessarily mean you're gonna buy the Swiss franc futures. All right. Now, you just want to show you. Now, if I changed now the zones to this one, if you say, nah, I would have drawn this zone and would have been also absolutely right. You see, we are still in equilibrium. We're closer to expensive, yes, but we are still in equilibrium. And now if price comes up here, you would look to short. And if price comes all the way down here, you would potentially look to buy. And that location step, now we did the example based on the Swiss franc futures. You could do that on every single market that you want. You could do it on Bitcoin. You could do it on gold. You can do it on a Nasdaq. You can do it on any market where you have a candlestick chart. And it's always the same process that we just covered here. The rules are slightly adjustable, some of them, but predominantly the rules that I gave you are very conservative rules, very high quality rules, but they can be obviously adjusted. So let me know in the comment section how you like this channel, if you have seen something like this before, if you enjoy these kind of lessons. Please, the participation is so important to make these videos seen by a lot of people, and I really appreciate all your great comments. It really means the world to me. Thank you, and see you on the next supply and demand lesson. Bye.